Welcome back to the channel. My name is Patrick, and in today's video I'm going to address a question that was asked in the comment section a few hours ago. I don't waste no time. I actually just finished taking a trade, and because I was taking a trade, it helped me, it's going to help me illustrate the point that I am going to make. Okay, so let's start with the question. It was, what would you say are some limitations to using moving averages on the chart for reference as to where price is going and where price touched and reversed from? Okay, so essentially, what are the main limitations for using moving averages? As you know, I don't use them. Okay, I have used them. When I started, like most traders, we all start with moving averages because we are completely lost. We do not know what to do, and we are told that moving averages is the best indicator to get you started. And you are told that the 10 EMA or SMA or MA or whatever, it's all moving averages, is a good indicator. Then some people pair it with the 20. I've got the 20 here and I've got the 50, and they do variations of this. Okay, so I just thrown up three of them here. Okay, so we've got the 10 here, which is the red, we've got the white, which is the 20, and we've got the 50 here. Okay, so where to start? The main limitations of using moving averages is it's not an indicator. I mean, that's the worst branding or worst name it could have been given. It's called an indicator. An indicator is to indicate what price is about to do, right? Okay, cool. So what do we see right now? I mean, like, what do we see right now? Is it curving? Is it getting ready to cross over here and maybe reverse and go down? Is it bouncing off this 20 and pushing back up? It's whatever you believe it's going to do, whatever you thought it may do, whatever you've been told that normally happens when it hits a certain zone. Whatever bias you may have is what you're seeing right now. For me, clearly, these indicators are not telling me nothing. It's okay, telling me that price is moving up. Okay, because these, let's zoom out a little bit. If you zoom out, you see here it's come down, did the crossover here, it reversed, and it's trending up. That's what it's telling me, right? Cool. But guess what? If we took off the indicators, let me naked chart this 1 second. Let me see. First point, naked charts. If we took off the indicators, we could see exactly the same thing. We could see exactly the same thing. Pole and flag. Look, we have our low, our high, our low, a higher low, a higher low here, a higher low. It's trending up. We can see that without the indicator. So the indicators actually just replicate what we can actually see, what price is actually doing. So it's not telling us what price is going to do. It's telling us what price has done. That's why they are lagging. That's why they are only visible after price has printed these candles. So they just retracing the steps of what price is doing already. So the main limitation of using indicators is they are lagging. Okay, they're not predicting the future. They are telling us what we can actually see. So that's the main limitation. So it will serve you better to learn how to read naked charts. And once you learn how to read naked charts, you don't need indicators. Okay, you don't need something that's telling you what's happened already. Okay, if you learn how to read in the naked charts, you know where price is going to reverse at or should reverse at. Okay, so for example, all right, let's get these charts back up. Let's see if we could get these indicators back. You have to bear me a second. I have to get them back. Okay, so let's see. Indicators, moving averages. Let's get the 10 back. Let's get the 20 as well. I used to like the 20. I really did believe, when I first started, I really did believe these indicators were telling me what was going on. I had so many indicators with all the colors here, and I believed that price always reacted to them. Okay, that's what I believed. And in truth, it looks like it's reacting to them, but in truth it's actually reacting to supply and demand zones. I'll touch on that in a second. And let's get the 50. Okay, cool. Oops, got the same color here. And let's make this something nice and bright. Alright, cool. So back to where we were. Okay, so that's the first limitation with indicators, is they are lagging. They don't tell us what price is going to do it. Okay, so it looks like it's reacting now from the 20, but really it really is reacting for this demand. If you've been following the channel, you know supply and demand. We flag and pole. There's a pole up, it flags down, consolidates here, and this is a pole up. So when it comes back to this zone that broke structure, it should react. Okay, so it comes back here and it should be brought up and try to push back up if it's continuing this trend. However, it could fake like it's continuing up here and break. And why I believe that is not because of this indicator here. Okay, it's because of price action. I believe that this is going to come down, and the reason I believe that is, I'll show you in a second, but I took a trade based on this. Okay, so let me just illustrate this point. Now I took a trade from here, right? Let me show you my trade history quickly. So I caught a trade right at the top here. As you can see, the indicators are not even caught up here. There is no crossover here. There's no indicator to tell me that I should have taken that trade. Let's go to the lower time frame, M1. Again, it's not even crossed over here. It's only starting to cross over here. So if I was following the indicator, maybe I'm looking for a trade from here. Indicator would have told me to get in here. Why did I get in here? Okay, let me show you. This is the main benefit of not using indicators. This is the main benefit. Let me just mark up my entry. And I had a stop loss which was just above there when price started moving. But let me just mark out my entry for now, and let's zoom out and I'll show you why I got in there. Okay, cool. Where we? Okay, we need this. All right, cool. Let's look over here. So supply and demand again. So we were trending up previously, it reversed here, it created we got a low here, high low, high low, high low, high low, trending up, high low. Here it broke structure because this point here is a new low, which is lower than this. Okay, then what happens? It fails to create another high. So high low, high low, high low. Higher highs in the process and stops there. Okay, this fails to create a higher high, and this now creates a lower low. Okay, so it's reversed there. Looking at this indicator, look at the charts here, the crossover happened here, but reading the naked charts, we first see our indication that price is reversing here where it broke this low. Okay, so when it pushes up here and fails to beat this high and pulls back down here, yeah, and pulls back into that zone where it failed to beat that high, our entry could have been here. Okay, so now on the charts with the indicator, it shows a crossover has happened here. But when reading this live, this is historic data now, right? When reading this live, you wouldn't have got this drive down. I saw this drive down when it happened. It was too quick for the indicators. The indicators are lagging. They print after the move has happened. So you wouldn't caught this drive down. And this is the problem. When you look at charts, historic data with indicators, it looks beautiful. It looks like, oh, that was a crossover and so on. If I use this indicator, I would have found a perfect entry and that and so on. But when you are trading live, the indicators do not show you that, because they only show you after the move has happened because they are lagging, right? Cool. So that's another limitation. Okay, so they don't show you the best entries, they don't show you what price is doing, and they show you what price has done. Okay, so this is a reversal now. Okay, because of naked charts we can see that, and now the indicators caught up and produced that. Okay, so it's now trending under the, what was that, the 50 EMA. So you're catching trends and so on, trades based on that. Some people catch trades when it pushes above the 20 EMA or SMA or whatever, and when it comes back down, they enter there, putting their stop loss above there, and they try to ride this down. Okay, but again, flag and pole. There's a pole, this is a flag, this is a pole out. When it pulls back into that zone here, let me just mark it up. Right, well, I've marked it up a few times in my videos, so you should be able to see it, but let me just quickly box this up. Let's see, shapes. Okay, cool. Let's quickly box this up for the new viewers. So from this low to this high here is our zone, okay? That's the zone where it consolidated and broke out from. So when price pulled back into here, that could have been your entry, stop loss could have been above there, and get that drive down, okay? And that would have continued the flag and pull. And you can see that's what happened. It pulled in here and broke out. Okay, cool. So following that trend, I was looking for a trade setup this morning. So I was looking for an unused zone, okay? So if you look here carefully here, let's get back over. Okay, cool. Let's get back over here. Okay. So back over here, let's zoom in. Okay, so I think we need to get in a little bit closer. Alright. So we have our flag and pole. So it's reverse here, it pulls out, flags, consolidates a little, then here it pulls out. Okay, cool. If you look carefully here, which is hard to see because of the indicators, another limitations, the indicators actually distract you. I forgot to mention that. They distract you from what price is doing right now. Okay, so if you look carefully here, when we pulled out, it actually flags up here and pulls out. Okay, and since it's flagged, it's pulled out here, price did not return to this zone like it has the previous zones. Okay, so it pulled out here, flags, pulled out. This flags and returns back to this little zone here. Could have caught the entry there. Based on this low here, the indicator would have told you what? There's no crossover. I don't know. You enter based on the EMA, 20 EMA maybe, but flag and pole, you would have caught it right at the top there. Okay. If you waited for the 50, you would have missed it. So poles out here, poles out here, flags here, and pulls again, and as you see, it did not return to that zone. Okay, cool. So this morning I was waiting for a entry. I was waiting yesterday, to be honest. It didn't give it to me yesterday, and this morning it did. And the reason it didn't give it to me yesterday, because price is very slow. We are in December, a few days away from Christmas. Okay, so you can see I marked that the zone here. You can see it just enters into this zone here, just touches into this zone here, and I entered there. Okay, my stop loss above the zone, just above there, right? So we were looking at a stop loss of about 8 pips, and I took it back down to the previous zone. So I took it from supply and I ran it down to demand. That's it. No indicators needed. Okay, so I took it from this entry here to run it back to this demand. Remember, this is doing the same thing. This consolidated and broke up. Okay, so I expect price to return here to clean up this inefficiency, and then from here it could drive up again. Okay, so for it to come back down, it needed a zone. It needed somewhere to push it back down. Okay, and that's what I traded. So I entered there and took it back down there. Okay, and now from here it could be bought up and pushed into the zone and past the zone, or it could hold it and go down. Okay, now we will see what's going to do. Trade history again, as you can see, entered right there, took it to that zone, I was out. That was all I needed. It was about, quickly, it was a 9 pip move. Would have got 10, but 9 pip was enough for me, and that was it. That's me done for today. Okay, so now back to what I'm saying. Okay, so the indicator wouldn't have told me to get up to sell from here. As you can see, price it has not even got up to here yet. All right, it could have told me to buy from here. So if you're trading with the trend, you could use indicators to trade with alongside the trend, right? Cool, but again, it's not necessary. Let's get rid of these indicators right now. So we can see it's reacting off the 20, at least it looks like it is, and it's pushing up. And there's no indication that I got to get that sell, which I got, and there's no indication of what price may do now, which I believe is due to reverse soon. Okay, it may reverse at the zone or it may reverse at the higher zone. Okay, let me just get back to where I was. Let's clean these charts up, and hopefully it reverses in this video. I'll show you what I'm talking about. Okay, so let's see. Let's just zoom out again. Okay, cool. So why do I believe it's reversing and going further down? Well, it's reversed here and it's pushing down, and we have, okay, so it's 50-50, let's be honest. Okay, cool. So it trended up here, created this imbalance here, right? Price reversed here and came and filled this imbalance. It's now reversed here and it's pushing up. Got to top here and you would expect it to break this zone, but instead it pulled back down to sit into this demand. There's a demand there, look, pole, flag, and pole again. It comes into this demand there and it's reversed and pushing up. Now the reason I believe it's still going down is because it's left some inefficiency here. Okay, so it's left all these it's an imbalance, basically, potentially unfulfilled orders here, and that's why I believe that it's going to hold here and it's going to push down back into this zone and then consolidate through the rest of the year, and maybe in the new year it continues its uptrend. Okay, the same way it came down from this high here, instead of continuing its bullish trend, it came all the way down here to fill this inefficiency, reversed here and continued. I believe it's going to do the same thing here. Okay, just based on reading these naked charts. Okay, there is no indication of this. Let's get the indicators back up one more time just to illustrate the point again. I think I hope I'm getting through to you. I hope I'm making myself clear. Indicators do not predict what's going to happen. They are not an indication of what's happening, and they're not very useful when you're reading live charts, because they are distractions. When you got 2, 3, 4 different colored indicators over price action, it's actually hard to read what's going on in front of you. So as you see, when I get rid of the charts, it's so clean, it's so easy, so clear to demonstrate the points I'm making. But when you got the indicators all over them, okay, 20, let's get the 20 and let's get the 10. When you got the indicators all over them, it's actually hard to see what I am talking about. So if it's hard to see what I'm talking about and we're not actually trading, imagine when you're trading, when you got the emotions, you got the stress, you got the anxiety and all that adrenaline kicking, and you got all these squiggly lines in front of you. It makes it a little bit more difficult. As you can see, we can't really see what's going on with indications here. Okay, higher time frame H1 is saying there was a reversal here. We saw that on the naked charts. We saw why based on this. It didn't tell us why. Indicators didn't tell us why it reacted to this zone here. Okay, why did it react to this zone? There's no indication telling us that. Okay, supply and demand does. This is the zone that pushed it up. It came back, filled all these pending orders remaining here, filled every single one of them. Look, it cleaned up all this inefficiency. This was a news catalyst, by the way. So it came back, filled all those orders, reversed and continued its uptrend. It can still continue up there, but I believe, strongly believe, it's going to come down here at some point to fill this in. It may pass this zone and come back later. It doesn't matter. All I know is going to come here, and because I don't know when it's going to come here, that's why I don't hold my trades and just hope it goes there. Okay, I just scout my moves. What I do with this information, again, indicators need to go. What I do with this information is plan my trade out. Okay, so I've seen. This is how I use supply and demand. This is how I trade without indicators. I look for reference points, points of interest, POI, points of interest. That's what everyone calls them now. So This here is my point of interest. If price gets to this zone here and puts in a reversal on a lower time frame, I am going to trade it. The same way that price got up into this zone here, it tapped there and pulled back out. It also did this on the lower time frame. As you can see with this inefficiency here, so this inefficiency here, this imbalance here, it did it here. I used this as a reference point. When price got back to there, I took my entry. If you go into a lower time frame, you will see why. Okay, cool. So look, this is the reversal pattern I like. So we had a trend, a higher low, higher low, higher low, higher low, all the way up. Yeah, creating higher highs in the process. And what does it do here? It pushes up, it pulls back down, fakes like it's continuing and breaks. That is a reversal pattern. It's known as a head and shoulders reversal pattern. It's the reversal pattern I prefer to trade, okay? And that there, it pushes it back down and takes it where to this demand, which had the imbalance, and from there it's pushing up, okay? That little scalp is all I needed. That is a 2-pip risk to gain a 8-pip move. So that's a 1 to 4 just on that little move there, okay? Usually I trade this on a higher time frame, which is M5, not M1, but because price has been very slow, I've adapted to the current market conditions, okay? I've been trading on M1 recently because the moves are, you know, very short-lived, and I'm trying to tighten up my risk, and that's what I'm doing, and that's how I'm adapting to this situation. So I use this supply and demand using flag and pole, find the price point, POI, point of interest that I was interested in, waited, price then reverse, creating that reversal pattern here. You could have entered here and taken that move down there, okay? You could have done the same thing on a higher time frame on another day, not right now because price didn't give that same reversal pattern, and it won't because at this time of year it's been very slow and choppy. It's not been producing that, so that's why I went to a low time frame. So same thing when it gets to this H1 point of interest down here. I'll then go to M5 and look for that same pattern where it looks like it's continuing faked and goes, and if it does that, I'm looking for entry to take it up, okay? And that is how I trade. None of that is visible using indications. Indications distract you from that. Indications are lagging and they do not predict or tell you what's going on. They do not indicate the future. So I think I've made my point. There's a few points there, but I've repeated it and demonstrated a few times. So hopefully you get the message, and hopefully I've answered your question in full. If you found this useful, hit the like button, hit the subscribe button. Any questions, any comments, let me know and I'll address them, okay? I'm still trading. I have taken a trade today. I haven't taken much trades this week or the previous week, and I don't think I'm going to be taking much trades continuing because we are days away from Christmas, and I expect the market to slow down and start really chopping. Okay, so there is news today. That news in catalyst may get this price down there, and after that I just expect this zigzag all the way through to the new year. So I don't plan to trade. I'm going to enjoy the time with my family. I suggest you do the same, and I will touch base with you guys when I've got something to discuss. And until next time, this is Patrick signing out. Peace.